The entire world owes $315 trillion. The United States, $38 trillion. Japan, $9 trillion. The European Union, over $14 trillion combined. Here's the question nobody asks. If every country is in debt, who are they paying? The answer is not a secret cabal. It is not four men who planned this across centuries. The answer is more interesting and more important than any conspiracy theory. Today we are going to trace how modern government debt actually works, where it came from, and what the real problems with it are. No myths, just documented history and honest economics. In 1694, England was at war with France. King William III needed money fast. The royal treasury was empty and traditional lenders were refusing because England had defaulted before. A Scottish merchant named William Paterson came forward with a proposal. He would organize wealthy merchants to lend the government £1.2 million, roughly $300 million today. In exchange, Parliament would guarantee 8% annual interest. To manage the arrangement, a new institution would be created, the Bank of England. Parliament approved it. The subscription was fully funded within 12 days, which tells you how attractive investors found it. The original charter actually gave the government the right to repay with 12 months' notice. What Paterson's model established was government debt backed by Parliament's taxing power. That guarantee made bonds trustworthy. Trustworthy bonds are tradable bonds. That was the foundation of modern sovereign debt. You have probably heard this one. Nathan Rothschild learned of Napoleon's defeat at Waterloo before anyone else in London. He crashed the bond market, bought at the bottom, and made millions overnight. Compelling story, also completely false. It originated in an 1846 French political pamphlet written under the pen name Satan. Historian Brian Cathcart researched it in detail, and the Rothschild archive confirms. Nathan was in London that day, not at Waterloo. The timeline does not hold up. The story spread because it fit a pre-existing anti-Semitic narrative. It was later used in Nazi propaganda. Repeating it, even casually, is not just historically wrong. So what did the Rothschilds actually do? The five brothers established banking houses across Europe, London, Paris, Frankfurt, Vienna, Naples, and used their network to move money across borders faster than anyone else. They genuinely helped Britain finance the Napoleonic Wars, which the British government formally acknowledged. Their real innovation was making government bonds tradable internationally. Before them, sovereign debt was private negotiation. They turned it into a liquid market. That made it harder for governments to simply default. But it was a market development, not a conspiracy. And J.P. Morgan had to personally organize a private bailout. It worked, but it exposed how fragile the system was. In 1910, bankers and Senator Nelson Aldrich met secretly on Jekyll Island, Georgia, to draft what would become the Federal Reserve Act. Yes, the meeting was secret. That is historical fact. They kept it secret because they knew public association with Wall Street would sink the bill. Now here is what most people get wrong about the Fed. The 12 regional Federal Reserve banks are technically owned by member banks. But the Board of Governors, which actually sets monetary policy, is appointed by the President and confirmed by the Senate. And the Fed's profits after expenses go to the U.S. Treasury. In 2022 alone, the Fed sent over $76 billion back to the government. It is not a private bank secretly controlling the country. But it is genuinely influenced by the banking sector it regulates, and that tension is a legitimate policy debate worth having. By 1979, U.S. inflation had hit 13%. Paul Volcker, the new Fed chairman, made a brutal call: raise interest rates until inflation breaks. Rates went from 11% to nearly 20%, the highest in American history. Inflation fell, but the side effects were severe. Throughout the 1970s, developing nations, Mexico, Brazil, Argentina, had borrowed billions in US dollars when rates were low. Suddenly the interest on those loans tripled. In August 1982, Mexico announced it could not make payments. The debt crisis had begun. The IMF stepped in with loans but attached conditions. Governments had to cut public spending, privatize assets, and open their markets. These were called structural adjustment programs. Here is where honest disagreement exists. Supporters say these programs restored fiscal stability. Critics, including former IMF chief economist Joseph Stiglitz, argue they caused unnecessary poverty and stripped countries of economic sovereignty. The evidence on both sides is real. This is a legitimate ongoing debate, not a settled question. So why does government debt keep growing? Is it a trap? Partly, but not in the way it is usually described. Government bonds are used as safe assets by pension funds, insurance companies, and central banks worldwide. If the US paid off all its debt tomorrow, trillions in safe assets would vanish from the financial system, causing deflation and instability. But debt does not have to grow forever. The relevant measure is debt as a percentage of GDP. Britain carried debt at 250% of GDP after World War II and brought it below 50% by 1970, not by paying it off, but through economic growth. Several countries have done the same. The real challenge is political. It is always easier to borrow than to tax or cut spending. That is not a conspiracy. That is democracy under fiscal pressure. 315 trillion in global debt is not the product of a secret plan by 4 men across 3 centuries. It is the product of real historical decisions by governments that preferred borrowing to taxing, by institutions that made debt tradable and harder to escape, and by lenders whose conditions have genuinely hurt vulnerable countries. The problems are real. The inequality built into debt service is real. The pressure on developing nations is real. But understanding those problems accurately is what lets us actually address them.